All right, good afternoon. It is now about 5 minutes after noon, so hopefully everyone has joined us. Welcome to our December webinar, A Year in Review, a look back at financial markets. I'm Dave Clayman, co-founder and principal and CEO here at 12 Points. So I think most of you know me, but for those of you who don't, I've been with the firm now obviously since its founding almost 4 years ago. And prior to that, did 20 years in the investment industry, and I handle the capital markets primarily for 12 Points. And I'm joined here by Manny Frangiadakis.
Hello, everyone. Good to be with you. Happy December. I'm Manny Frangiadakis. I've been with the firm since its inception as well, about 4 years now. Been in the industry a total of about 8 years. I'm an advisor both for the corporate retirement plans and our personal clients, and I live and breathe the markets on a daily basis. This is my passion. So we'll get started in review 2017. Obviously, it's been a wild roller coaster of a year from a political standpoint, from a financial standpoint, from a regulatory standpoint. Obviously, the year started off a little shaky with the election of Donald Trump and how the market originally took it. But since that, and with the hope of tax reform and infrastructure spending, the market has gone nothing but up on most indexes.
And I think that's the key, too, is one thing that we've been missing is any kind of volatility. Unless something happens in the next 2 weeks, this will go down as the single least volatile year in history. We have not even had a 3% correction in over a year. So that does concern us. Markets aren't meant to run to the sky. I always describe it as you want to see a market like you climb a brand new set of stairs. You kind of put one foot up and you test that next step to make sure it's safe, and then you put your both feet on it. And this market's just been running up the stairs saying, I'm sure they're built just fine. So let's take a look at what's happened so far.
So absolutely. So, and it's not just here in the U.S. We've seen it around the world. And the U.S. has definitely been the leader for the last, 9 years. We're in the 9th year of an expansionary bull market. But this year we actually saw the likes of Europe and emerging markets catch up, and actually emerging markets leading the way, as most people and investors transitioned that way after the election. There was a view out there that we would be having a weakening dollar, and with that aspect that we thought emerging markets would finally be able to catch up to equities around the world.
And for those of you who are invested in our models, that's exactly our largest allocation has been to emerging markets. We were about a year early on that call, but again, as Manny alluded to, the strong dollar last year hurt that. This year, with the dollar weakening a bit, has been an improvement. And the reason we like emerging markets is because they're growing faster generally than the U.S., and they're a lot cheaper than the U.S., which is unusual. Historically, they are priced more expensively than the U.S. So we think valuation-wise, there's a lot more room for that trend to continue. And historically, when trends like that have emerged, you've seen them last anywhere from 5 to 7 years. And we're, again, about maybe 11 months into that cycle. So we think there's a lot of room to run still on that cycle, on that theme.
Absolutely. And along with that, as Dave mentioned, we haven't found much value here in the U.S. in terms of U.S. equities. So as well with other investors, we've been on the hunt for yield in 2017. So we actually went out of the normal scope of investment strategy and included some of these asset classes as our largest holdings, and they've actually performed pretty well with actually subdued volatility.
So yes, private companies where less people can access them have been cheaper, which is again unusual. So we're looking forward to that continuing. Real estate continues to be steady again, but you don't want to look at a lot of people think they get diversification by owning a REIT or a real estate investment trust. If you look historically, a REIT looks almost exactly like the All Country World Index over a long period of time, because as one of my favorite market commentators, Art Cashin, says, when you can't sell what you want to sell, you'll sell anything, including grandma's necklace. So someone who needs liquidity in the time of a market scare is just as quick to sell their REIT as they are their stock or bond. They're not as likely to sell a private building. No one sells a building because the stock market drops. So that's a good reason to try to get access to private real estate if you can. And then private lending has gotten very attractive. Government bonds offer almost no yield thanks to the Federal Reserve, and European bonds, even worse, negative yield. So where we found value is in private lenders. Those loans are often also based upon FICO score. And frankly, for those of you who remember the 2008 market disaster, a lot of the loans that went bad were rated AAA by a Moody's or an S&P rating agency. So I actually trust the ratings of a FICO agency more than I trust the ratings of maybe S&P and Moody's.
Absolutely. And you can see by this chart how they've performed actually compared to the stocks. So besides that fact, we'll take a look at the interest rate market. As Dave alluded to, it hasn't been great with the Federal Reserve, the BOJ, and the ECB and the Bank of England keeping rates around the world subdued. So we haven't seen much growth in the interest rate sector, and that has transpired into also the high yield sector, as Dave alluded to previously, that high yield in Europe is cheaper, is yielding less than a U.S. Treasury at the moment, 10-year Treasury, which is absurd.
And if you take a look, so having been in the industry for 20 years, I remember when I got into the industry, people used to plan for their retirement by saying, I need to get about a couple $1 million and get a municipal bond portfolio that yields me 6%, and I'm going to have $120,000 a year of income in my retirement. Well, that $120,000 now, if you're buying those bonds, is $40,000. So it shows you how much that yield has dropped off, and people have been predicting rates to rise dramatically for the last 5 or 6 years. It hasn't happened thanks to the bond buying programs of all those government banks that Manny mentioned. So I don't know when rates will rise. I do know they will eventually, but having gone through, as Manny said, a 9-year expansion and rates haven't risen yet, my guess is that we're closer to a recession than continued expansion. That likely means that rates will stay subdued for quite some time.
Absolutely. I think that you probably, in our mindset, thinking that we will have, we just raised rates yesterday, but I think that 2018 is going to be key to see what the Federal Reserve is going to give us in terms of their dot plot projections and how many times they expect to hike. And, but again, like Dave mentioned, 9 years in an expansionary bull market, flattening yield curve, we're looking at possibly a U.S. recession in the next year or two. We could see a limited amount of hikes before eventually we might need to actually drop rates even lower. In the commodity sector, it's been about 8-9 years now that we haven't really seen much growth and movement in commodities. A lot of that had to do with the strength in the dollar, which also occurred during that period of time. We are starting to see that trend slowly change, and obviously with the drop of oil a few years back, and it's slow but steady climb since then, we're slowly starting to see the commodity sector gain a little bit more popularity. I would imagine until we see something happen in U.S. equity markets or equity markets around the world, that real tangible assets probably won't get the attention that they deserve. We are believers in gold. Currently, gold has been trading down these last few months, but we still believe that you could end this year around 1,300 and possibly 1,350 to 1,400 for 2018.
And as Manny mentioned, oil, the OPEC is desperately trying to balance the supply of oil, but here in the United States, we just continue to produce more and more. The current prediction is that we're going to produce over 10 million barrels a day here in the United States. That's up from 8 million just a couple of years ago, so almost 25% growth. The reason that we own the pipeline positions that we do is for exactly that reason. The pipelines act as just a toll road, collecting a fee as the oil flows through their pipelines. So many investors sell pipelines not realizing it's not the price of oil you care about, it's the volume of oil. So that continued growth in U.S. production, which the Energy Information Administration just came out this morning and raised their guidance by another 120,000 barrels a day, that oil is going to flow through those pipelines and should make those pipelines even more profitable going forward. So even though the position is down for this year, we continue to love it because we think it's being misinterpreted.
Absolutely. So kind of giving a little bit of a screenshot here, things that we are overweight and underweight. As we previously mentioned, emerging markets, is one of our best ideas of 2017, and we continue to believe that going into 2018. Alternative asset classes, commodities like gold, we have higher exposures to European equities than we do US, just from a valuation standpoint. Just like emerging markets, Europe has actually trailed the US the last couple of years, and we've seen actually them starting to pick up steam and come back. And we are underweight US, and the reasoning behind that is we think that this is a valuation-driven market and not an earnings-driven market. Typically, we as investors usually like to buy a lot of what's cheap and sell a lot of it of what's expensive. And as we see value not really on the horizon in the US, we will await for some kind of pullback. And when we see an opportunity, that's when we'll be ready to jump in.
I think McDonald's is a great example. You know, McDonald's is trading at 25 or 26 times earnings. Historically, McDonald's is traded anywhere around 14 to 15 times earnings. So you could argue that McDonald's is almost 40 to 50% overvalued. So that's a stock in particular. You know, their sales have actually declined each year for the last 4 years, but the stock has gone up by about 40%. So that's what Manny talks about being a valuation-driven market rather than an earnings-driven market. We're not seeing the earnings to back up these valuations. And another thing, when Manny talks about the commodity sector not perking up and getting no attention, well, if we had such a raging economy to justify these stocks, you would imagine they'd be using up a lot of the raw materials and commodities that we're not seeing go up in price. You're seeing the household sentiment has hit an all-time high, and that concerns us as well. You want to be buying things when they're cheap and when everyone doesn't own them, and selling them when everyone does own them and when they're expensive, just like you do with anything else in the world. But people get very emotional. I like to say Wall Street is the only place I can think of where if you walked into a mall and one store said 25% price hikes and the other store on the right said 75% off, everyone in the world would walk into the store on the right, unless it was the stock market, when they only want to walk in when everything's high priced.
Right, and I think just to draw a comparison to that, as we keep hearing all this talk about Bitcoin and cryptocurrency, I think you can see it right there. There's your example right there alone. I mean, nobody was talking about Bitcoin when it was trading at $1,000 a coin or $5,000 a coin. I mean, it barely started getting mentioned when it reached 10,000, but now that it's creeping up to 20,000, which would be extremely expensive, now people want to buy it. Now it's when you're seeing people jump into it, and it's always that reverse psychology.
I actually had a conversation yesterday at my CEO meeting with one of the other CEOs who said that his son in college and his friends are now day trading Bitcoin for beer money. So they're literally trying to make $40 to $50 a day, and they think they have it timed out perfectly. It reminds me a lot of the way we were trading initial public offerings back in 99 and 2000. And I know how that ended. I suspect this is going to end the same. In fact, I just saw my first E-Trade ad, "Don't let your friends outsmart you," the other day. And I said, wow, I haven't seen this ad in 18 years. I guess it's that time again. So I think we see a lot of the signs of the top coming soon. So one of the things that brings to mind is that a lot of retirement plans, you have a job to do. You don't want to think about running your 401k allocation, or you don't want to be picking stocks. You just want to set it and forget it. So you enroll in your 401k, and they say, we'll make it easy for you. We'll give you a target date fund. You tell us how old you are. We'll decide you're going to retire at age 65. What's the nearest 5-year increment to that? And boom, there's your allocation for you. And you think you're pretty well balanced. One of the problems is that you don't realize how much U.S. equity is in there. So again, some target date funds are up to 93% U.S. equity. So even in the old rule of how much stock should you own, take 100 minus your age. If you're 35 years old, then you should be 65% in stocks. At least some of that allocation should be international. We're talking about target date funds having 90+% in U.S. equities. So I think that they're very aggressively invested. I know people are loving the returns. I sat with the administrators of one of our plans the other night, and she said, oh, I don't want to switch out of my target date fund. I'm up 22% this year. Well, that's great, and that's the time to take your money and run, and you should be excited about that. But let's get, more sophisticated about this. Let's choose allocations so we can help you with risk-based allocations. We have risk questionnaires that will give you an idea for, okay, my portfolio is really doing 95 miles an hour down the highway. and I'm more of a 60-mile-an-hour kind of person. So you can give your own attitudes towards money and the feelings that you'll have, and it will give you an appropriate allocation in a portfolio. So if you reach out to any one of us, we can help you with that. There are no target date funds that preference international equities versus U.S. equities, which even if you wanted a lot of equity exposure, as we mentioned before, we would argue it should be international. You can't get that in a target date fund. So again, we can help you with that if you want to reach out to us.
Absolutely. And just to highlight on that, we didn't mention this earlier, the other reasoning behind the growth in European equities and around the world is that we're actually tightening here in the United States while they're continuing to ease. So for the next foreseeable future, the European Central Bank will continue to pump liquidity into the system. Now that will probably be drained in a couple months or slowly be removed, but until that time, they actually have a lot more liquidity right now than we do, and that's why their equities are outperforming. And to highlight what Dave mentioned about 22% return on a target date fund, that is unbelievable. You don't really see that sometimes in investments unless you're able to really pick something at the bottom and ride it all the way to the top. And to quote JP Morgan, I mean, when people asked him how he got rich, his response was always, I took my profits early. And I think when you have an opportunity like we do today, that if you have been invested and you are up 18%, 20%, it's a really good time to take some of that risk and chips off the table.
And one of my other favorite quotes about the market is, how did it go down slowly at first and then all at once? So that's something you can tend to see. As far as trends we can see developing, of course things are uncertain. There's a famous quote, markets can stay illiquid longer than markets can stay illogical longer than one can stay liquid. So what does that mean? If you're the person who thinks they are going to go down and you want to bet against it, the market can prove you wrong in a hurry and you can be bankrupt before it ever turns around. So timing is tough, but valuation historically has always been a great guidepost. So if you're investing for the long run, always keeping that, you think of a ship, that beacon on the horizon should be your valuation and you'll get home to your goal. So something Manny mentioned earlier, European high yield bonds, which are pretty risky right now. You're talking about a lot of bonds that are in what they called just a couple of years ago, the pig countries, Portugal, Italy, Greece, Spain, Ireland. You look at those countries, those are the kinds of bonds you're buying, and they're yielding less than a 10-year treasury. So they're saying that the market is telling you that there's less risk because you're getting less return for your money. There's less risk in those high yield bonds than there is in a U.S. treasury bond. Regardless of your political view, that's still a pretty scary analysis.
Yeah.
And the reason that's happening is because the European Central Bank pumping all this money, they're buying these bonds, and that's been an artificial support. Manny mentioned they're starting to drain that liquidity, and so you're going to see those bonds start to trade up in price, down in price, up in yield, I think. So that'll be something to watch for. And then the other thing that doesn't make any sense if you look at history, the spread between short rates, so the Fed, as Manny mentioned, keeps raising rates, so short rates, the 30-day, the 1-year, and the 2-year all keep going up in rate, down in price. The 30-year bonds are going, and the 10-year bond are going down in yield, and up in price. So what you're seeing is that curve is flattening. The spread between short-term money and long-term money is going down. That historically has always been a sign of a recession. Gotten a couple of false signals, but it's generally worked throughout history. So that shouldn't be happening with a rising stock market. And one of the really ironic things about it is that the rising stock market has largely been led by the banks for the last few weeks because of the quote-unquote good news, except that banks make money by paying out their depositors the interest on your account. That has been going up, what they're paying out, and they collect the loan interest on the longer, and that has been going down. So their earnings have actually been compressed. And I had to laugh the other night because I turned on our dear friend Jim Cramer on CNBC after a big day rally in the banks, and he was screaming about how great the market was because the banks should have gone down 3 to 4% that day. Instead, they went up 3% because the news was so bad for them, but this was great for the market because the market has now become illogical. I personally don't like putting my money at risk in illogical places. So again, a reason that I think we should be concerned, conservative. That's the way we're developing our portfolios. That's the way we continue to be, and I think it's the right moves.
Absolutely. What we're seeing right now is just complete irrational exuberance, and we're getting to a point where it's getting much more important to return your capital than the return of your capital than the return on your capital. At this point, I think you want to be safeguarding your assets, taking what chips you can off the table, and not putting more at risk than you need to. Hedging strategies, these are what we include into our portfolio in the event of a downturn. If we do see something going on in the U.S. economy that spells something of a recession in the future, or if U.S. equities or international equities have a downturn. So what we've been doing is buying protection through, what we can do is buy protection through the VIX. I would imagine go long volatility. You would make money as the market went down. Limit exposure to U.S. equities, like we mentioned. We haven't been there for a while now, and probably won't be until we see some kind of a pullback. Like David mentioned, this is the longest we've ever gone without a 1%, 3%, even slight correction in U.S. equities. And utilizing option contracts and being able to create some kind of income while investment in asset classes move down.
Yeah, and we used the VIX for protection in our portfolios back around Brexit. We don't see any reason to use it right now, but it is a tool that we will keep in our tool belt. It was why our accounts were up even on the day when Brexit happened, when global markets were down 3%. We were up 0.25%. Buying gold, so gold should be a good hedge should the market drop, so that's something we look for. And then I think just being willing to look for value. So, even our partner Francesca teases me sometimes about will I ever buy U.S. equities again? And even last month we were in buying Macy's because we thought it was a good value. We were able to make 40% in a quick short-term trade. That wasn't my intention. I intended to hold it for a couple of years, but it moved very quickly in our favor and no longer was a value. So we continue to see that we'll be adding individual positions where we see value because the markets as a whole and broad exposure does not provide us any value right now.
Absolutely. So that pretty much concludes our webinar for today in terms of what we're seeing in the markets going forward and reviewing the past year of investments. We're here as a resource to all of you. If any of you have any questions, we really encourage you not to hesitate to reach out. We're always available to talk. Dave and I both live and breathe in the markets on a daily basis. We love talking about this stuff and reaching out to participants and clients and educating them on what we see out there.
Yeah, and in January, we will have our next webinar, I believe January the 16th. Like time, retirement waits for no one. Talking about why it's important to be contributing early and the freedom and flexibility that will give you in future years, demonstrating some evidence of compounding and how much flexibility that can provide you later on in life. So I know it's hard when you're young to be thinking about retirement, but thinking about freedom and flexibility is very important, and that's something we can demonstrate to you in January. Look forward to talking to you all then. Thank you very much and have a great day.